Hey, what's up, guys? Welcome back to the channel. I decided to do a YouTube video tonight. I think that it will be fun for me to kind of show you how I prepare for the week. This is something that I do every single week. It's something that ICT teaches in his month 12 core content of how to do top-down analysis. And we're going to be focusing on the weekly candle, daily candle, and then obviously setting up our trades for the week. And kind of this is how we anticipate or look forward to a daily or weekly bias. Where should we see the weekly candle expand? And we're going to use ICT concepts and go through exactly how I do it. It's not exactly how ICT teaches it, but this is something that I have made my own using the concepts that ICT teaches in month 12 of his core content. So let me show you kind of what we're going to be going over. Let me pull it up here. Okay. So this is the document that I use, and these are just bullet points that I pulled from his ICT intermediate top-down analysis video. We're going to be looking for the weekly to daily, and the focus is going to be identifying directional bias on the higher time frame weekly charts, classifying PD arrays accurately to assist in key levels, and complete institutional analysis on a weekly basis. So this is how I try to keep my trading professional. Is I go into every single day with a game plan that I have concocted during Sunday, usually around this time. I'll sit down when the market's live, which it is right now. It's moving, it's live, and I'll go through these steps one by one, and I will mark them down in a second document with notes and whether I believe that point is either bullish or bearish. And what I'll begin to see is I'll start to create a narrative for the week. And if I'm wrong, then I can change that up, and there's no harm or foul doing that. Forecasting is mostly just building up information. The more information you have, the more informed you are, the better decisions you can make. And that's how I like to treat this Sunday weekly outlook, is just by gaining information, getting me closer, getting a better feel of what the market's been doing without having to worry about, am I missing a trade or is my trade forming right now? This is my time to get close to the market, get a good feel for what's going on, and then to execute that plan throughout the week once I start seeing it unfold. So we'll start with relative strength. So essentially what this is we're going to look across the top assets. If we're looking for stocks, we're going to be looking at the top 30 industry groups for strong stocks ranked by IBD. So we're going to go to here. We're going to go to here. We're going to go to top 30 stocks by IBD. We'll go to the top 50 stocks and excuse me. Where is it? There we go. So you want to come to CNBC and you're going to look up this list. And this is the top 30 list in the Dow 30 chart. So you're going to see here, and you can go to Nasdaq 100. And you can see the top stocks in the Nasdaq. So here are all of them. Here's the list. And we're going to look at the top 30, see what's going on. Quick glance, you can see that this is the only one that was positive. There's a couple other ones down here that are marginally positive, but this was the biggest one. The rest of them are negative or very close to zero. This is marginal, you'll start seeing the 1 to 2%, and mostly bearish. So most stocks are bearish. And what you can do is you can go to these tickers. You're gonna have to click on it. Once you click on it, it brings you to a quick glance, and you can look at the past 3 months and see, okay, we've kind of created a high here and we move lower. If you make this a chart that has candlesticks, what you can see here is essentially a liquidity sweep below this level, and now we're looking for a continuation. So this is through December, January, and February. We swept liquidity, and for the sake of time of the video, I won't go into it, but you can look at these stocks on TradingView and you can see exactly what it does. That's exactly what it does here. Liquidity sweep and continuation. So that's how we determine relative strength. Now we're going to look at across the different indices. So we're going to go here. We're going to go to our indices page here. I have the list of all the indices, mainly S&P 500, Nasdaq, and E-mini Dow Jones. So what we're going to do is we're going to look and we're going to see, okay, which one is the leading and lagging. The way you can tell is which one is moving the most and has the most directional premise. You can see that the S&P 500 is strong. You can see that the Nasdaq is stronger than the S&P 500, and you can see in that same move that the Dow Jones is not as strong. So the big mover right now is the Nasdaq. This is where you're going to see the most explosive moves. This is where you're going to see the most movement. That candle, this black candle on S&P 500, and this candle on Nasdaq are pretty much the same, but as you can see, the range of movement is a lot higher with the Nasdaq. So this is your leading. This should confirm your trades. You can use S&P to confirm your trades if you're trading on Nasdaq, or vice versa. If you see Nasdaq starting to move in a direction, most likely S&P will follow. Same with the Dow Jones. Most of the time you'll see this be the divergence or the diverting indice out of these three. So relative strength is Nasdaq is leading and we created a failed swing. That's important. Throughout this whole presentation, if you feel like you would like to take notes, that is great. Pause the video, take notes. I'm going to go over my notes. I'm not going to show my notes, but we will go over what I talk about in the highlights. So all of this I have written down in a document, and I won't share that on YouTube just for my sake. But if you feel like you'd like to take notes during this, feel free, go ahead. So relative strength, Nasdaq's leading, great. Move on to the next section. Relative strength, and then I just have these links so that I can watch the videos and review them if I need to. Commitment of traders. ICT has a whole video on this, which I have here. But we're going to go to this link right here. We are going to click on that. And let me pull it up here. COT is commitment of traders, and what this is basically the open orders that are in the market right now. So you have three categories. You have commercial, non-commercial, and how does this one say it? Non-reportable, which are basically retail traders. So you have the commercials, which are the setters of the price, and then you have non-commercials, which are large institutions, banks, everything like that, and then you have the non-reportables, which are the retail traders like us. So quick in and out lesson, we want to follow commercials, Non-commercials are going to be on the opposite end. You can see how they are opposing to the commercials. When commercials are short, non-commercials are long, and non-reportables or retail traders kind of just follow. They're not really part of any trend. That's why we are not the market makers, and neither are the non-commercials. So we're going to follow commercials. We're going to see what the commercials have done since last year. Whoops. So we're going to go to September. We're going to go to October, November, December, January, February. I'm going to open this up to about July. Beautiful. So this is what we want to be looking at. You're not so worried in this section about the price action. What you're looking at is the orders here. You're looking at the data from the commercials, because what this will do is this usually sets the high or the low. Commercials are usually make the peaks of the market. And this is just a little bonus content here of something that I learned. As you can see here, the commercials are short. You have your zero line, which is here, right about there. Zero, and these are short for the Nasdaq. But as we can see, Nasdaq has been trading higher. This is on a daily chart. Why would the market be going up and the COT data for commercials are going short? That doesn't make sense. Here's a little tip. We're going to look at the non-reportable or the retail traders, and we're going to see what the retail traders have been doing. So the retail traders essentially have been going long. This whole time, they've stayed long, they've stayed long, they've stayed long, they went short. Look at how it's opposing. When retail traders go short, boom, commercials go long. When retail goes long, commercials go short. When commercials go long, retail goes short. Same thing, retail has gone short, so commercials are likely to go long. And we can confirm this by non-commercials. Retail is going to either follow commercials or non-commercials. Where they have been following non-commercials, you can see the trend is similar. We are going to look and see what would create a bearish scenario. So commercials have been going short. They're starting to move away from going short into going long, whereas retail is going to go short. See how their directional bias is starting to change and it's going lower? Same with non-commercials. So they're starting to move lower. They're saying, okay, we're anticipating a short or a break lower for a correction. And commercials are saying, no. We're going to take that liquidity. We're going to take your orders and we're going to make money with them. So keeping that in mind, keeping that idea in mind, that market maker mind, we're going to use this. I like this website because I can see here, I can see the commercials, non-commercials, and non-reportable. These guys are heavy on the short side, whereas non-commercials are heavy on the long side, and the retail traders are longer on the long side. So long, and then these guys are longer on the short side. Or, yeah, buy it, go short kind of deal. So we're going to close that out, and we're going to go to our next section. So COT data is bullish for commercials and bearish for retail traders. So keep that in mind, and we're going to come back to that. COT data, done. Open interest, we'll talk about that separately, but essentially what it does is it confirms our COT data. And what you want to see is a trending open interest. If open interest is going higher and the market's going higher, that means we're in a bullish scenario. What we have going on right now essentially is open interest is moving lower for this contract. You have to think about open interest using contract months. So what you're going to see is you're going to see usually a incline or a decline in open interest at the beginning of the contract's life, and then you're going to see it kind of move away or move higher during the contract lifespan. So right now we are in the excuse me, we are in the Nasdaq. We're in the March contract. So at the end of March, we will see this contract come to an end, and then we'll start a new contract. And essentially, what open interest has been doing is volume has been climbing, and then about right here, it starts declining. Open interest starts declining as well. So we are in a bullish market with open interest moving lower and volume moving lower. So we can anticipate some measure of bearishness. Now remember, commercials are long. So any move lower would be a stop run, and then we would look for a reason to move higher. We haven't really done a lot of sweeping on a higher time frame of liquidity or grabbing more liquidity. This has basically been the 1 grab, 2 grab, 3 grab, 4 grab on a higher time frame, on a daily time frame of liquidity, and now we created a failed swing. So keeping all that in mind, we'll come back to that. We'll go back to our document here. Market sentiment. What has the market been doing, or what has people been saying about the market? And essentially what we like to do is we like to gather that information and ask the question, how would retail use that information to form their trades, and how would we be able to capitalize on essentially the opposite of that? So I give you a few ideas here. You can go to Bloomberg, DailyFX, News.com. Those are things that ICT has mentioned. He also mentions using a Williams %R indicator on the weekly chart of 10, 14, 10, whichever one most accurately represents highs and lows. And what you can glean off of that is, are we in a quote unquote premium or overbought or oversold condition? Right now we are in a overbought condition. So any measure of retracement would be a stop run. So market sentiment, everybody essentially that I have looked at, I won't give you my sources because I don't want to build any kind of sentiment in that direction or bias, but what I have been able to find is that people have been long and they don't want to short. So any movement lower, they're either going to have to fade that, or they're going to close. They're going to have to close their positions, which will create liquidity. Everybody is using indicators that are overbought, oversold, and right now a lot of the top stocks, especially in the Nasdaq 100, is overbought. So any movement lower would have to be a stop run or a move to liquidity in order for us to move higher. If it breaks that liquidity and it continues lower, then we are in a longer term sell program. But right now we're in a buy program. We're at all-time highs, and people want to see more all-time highs. So in order to do that, you have to generate liquidity, which is taking out stops. So there's that. We're going to look at the market profile. And these are the 3 questions that ICT talks about in his mentorship. I've just taken this and I have used it for my own analysis. Are we in consolidation? No. Are we trending? Yes, we're trending, but we also created a retracement. So we open up our handy dandy trading view here, and the market is in a trending model right here. But what we've done is we've created a failure swing. So we are potentially retracing down into an area of premium or discount, or this is going to be a longer term retracement down lower to a level that is way down here and here and here. We don't really know that. We're not really too worried about that for right now. But essentially what we've done is we've said, okay, the market is in a trending market higher, but we've created a failed swing. What does that mean? What significant is that? All of that is stuff that you can write in a journal. I have a journal. I call it my narrative journal. And what I do is I make notes and I create a story for each month and each week and each day. So, market profile. This is where I also look at what has the monthly candle been doing. So if we go here, and I'm just going to focus on the Nasdaq right now. We take ICT concepts and we go to the monthly chart. What we see is we see our open here, the low is here, the high is there, and we're still creating the weekly candle, or the monthly candle, sorry. If we go to the weekly candle, this is what we see. We see February, this is the first week, this is the second week, and we are starting the third week of the month. So using ICT power of 3, what we have seen is we've seen a rally higher, a rejection of that, a liquidity sweep above here, and what do we have on the downside objective that could potentially reach into for a monthly basis? Well, we have an order block here, and we have a fair value gap that hasn't been completely filled in here. So now we can start building a narrative using all the information that we've gone through: COT, open interest, relative strength. All of those lead up to a narrative or a bias. So you can use these on a weekly basis to kind of tell you or build a story around what we're going to do. So what I like to do is, if I were doing this live or already doing this, without me already doing it beforehand, is I would mark out the opening price of the month right here. And what I want to see is I want to see a displacement lower, and then I'm going to look for shorts. We haven't gotten that yet. We're close to it. But if I'm short, I want to see it move below that opening price of the weekly candle, because then this will be our manipulation for the monthly candle, and we'll continue to move lower for the rest of the month. So going back to our handy dandy market analysis, market profile, we've looked at that, written down notes. Now we're going to go to intermarket analysis. This is where I start marking up my charts, and we're going to go to our three sisters. ICT refers to these as three sisters, and we're going to look at intermarket analysis. So this is on the weekly chart. You can see that this has created a high, a sweep above that high, same with here, sweep, and then now it looks like there could be potential bearishness. So we go to the daily candle, same thing, failed swing, failed swing, failed swing. Downside objectives, relative equal high or relative equal lows below there, and then even below there we have fair value gap, we have fair value gap, we have fair value gap, we have order block, we have an order block, same thing over here. So you can start marking up your charts now and say, okay, if we are looking for downside objectives, where would we likely go? And if we're looking for upside objectives, we're going to have to wait for more information. But right now we have this high and this high on a higher time frame on a daily basis, pretty much across all three indices. We move down lower to a 4-hour chart. We see, okay, liquidity. We have relative equal lows here, resting here and here. We also have relative equal lows resting here, here, here. The Dow Jones has already taken that liquidity, and then it moved higher into this range and has rejected going higher. So that still confirms any kind of sentiment that we were building up that would be bearish. This is respected fair value gaps up here. This is respected fair value gaps and the order block. This is a rejection block on a 4-hour time frame. And then this I just want to show you what this looks like on the Nasdaq. This is a 4-hour candle. This is an order block. Look at how it touches into it and then rejects it. Boom. Beautiful, beautiful price action. I don't want to say anything too that would lead to any kind of conclusion, but if you are looking at an ICT model, which he spoke about on YouTube, this would be a great entry on a 4-hour, and then this is just a confirmation of a specific kind of model that ICT teaches, where he talks about market maker profiles. So we do our analysis, intermarket analysis. Now we can look at the dollar index. The dollar index should be opposing to what stock indices are showing. So here's my dollar index. We're going to go to a 4-hour chart, and I'm going to bring back my drawings. So this is essentially all that I have on my dollar index chart. I use it for higher time frame analysis only. Intraday, I use it sometimes. I'll go down to a lower time frame, but usually I'll stay on a higher time frame. And essentially what we've done is we have a daily chart here, and what we've done is we have come up into this range. We had a previous defined range of here to here. We came into internal liquidity, and then now this is our swing right here, and we have taken internal liquidity, and we come up into this daily fair value gap with these relative equal highs resting below that. This is a very key point, and I want you to pay attention to what I'm showing you here, because this is exactly what a market maker would do. If I have relative equal highs right here, resting here, if you want to call this a cluster of orders, above here is a cluster of orders, where would it go to fill those orders to then continue a directional move? Well, you have a fair value gap resting above relative equal highs. So what I'm going to do is, I know that there's a lot of sell side orders here that are just free. These are free opportunities to continue a move. So what I like to see is, I want to see orders come up into here, fill, reject this fair value gap, and then continue a directional move lower. Where we've taken this swing, we've taken internal liquidity of this swing, and then now we've taken internal liquidity of this swing. I would look for a external move on liquidity on a higher time frame, longer term basis below this low, because you have relative equal lows. Look at this. Relative equal lows on a daily time frame. Here's your relative equal lows. So build up orders, free sell side orders resting in this area, and then a directional move lower. As you can see, this is kind of a high resistance run on liquidity into this fair value gap. What I anticipate is a very sharp sell side curve down below these relative equal lows that would clear out sell side liquidity and generate orders for the buy side. We could potentially move below here as well, as we have relative equal lows. If you extend here, that low over to here, those are relative equal lows. So we have a lot of sell side liquidity. As you can see, if you zoom out on a daily time frame, we have a lot of liquidity on the sell side. We've kind of moved sideways, which makes sense because the Fed is trying to build up a sentiment for interest rates to be cut, and they're being very cautious. This is what caution looks like on inflation for the sell side of the dollar. So we have a lot of sell side objectives below here. And what we could potentially see is a move rapidly lower. I'm anticipating at least a run below these lows. So that's our intermarket analysis. We're going to go back to our handy dandy page here. So far, since we are bearish on the dollar, we should be bullish on the stock indices with intermarket analysis. One thing I do want to note, going back to the chart, is this fair value gap that I have right here. I want to see how it reacts to this, see if it really rejects it and breaks below this low. Uh, Doing so would confirm a bearish stance on dollar and a bullish stance on stock indices. If it does not, if it rejects going lower in this 4-hour order block that I have marked out, if I get rid of this one, this is a 4-hour order block. It's coming down into that order block. I would like to see it reject off of this order block. See how it's come down, tapped, tapped. If we break below this order block, below this original consolidation of this price leg, then we could expect a longer term sell side objective, especially where we have this buy side liquidity, relative equal lows, sell side liquidity here. This would be a short term bias on dollar index. If it's going lower, then stocks should be moving higher. If stocks are moving lower while the dollar index is moving lower, then that means something entirely different. But for me right now, this is my market analysis for what I see. So going back to our document, we're going to look at market structure. This is where you can mark out market structure and incorporate PD arrays, the PD array matrix. All of these points kind of go together, and how you would do normal analysis on lower time frames, you can apply to higher time frames. So I want to show you what that looks like right now. We're going to go to my NQ chart, and we are going to go down to a 1-day chart, down to a 4-hour chart, and I want to show you exactly how I've marked my charts up. So at the beginning you might say, wow, this looks like a lot, but we're going to start from the left side of the screen and we're going to work our way to the right side of the screen. All during this time, while we're doing this, I'm making notes in my own notebook, and I'm building a sentiment, or I'm building my own idea of what the market could potentially do. If it does not do it exactly, or if it doesn't do it the way that I see it and it does the opposite, that's just more information. That means that my idea was wrong, and that's okay. I'm not trying to necessarily be right. What I'm trying to do is make money. So if you're wrong, that's okay. You're not going to be right 100% of the time. No one is, not even ICT. No one is. So you have to be cautious, and you have to be willing to accept being wrong. And you might ask yourself, how do I know if I'm right or wrong? Well, this is a section that's going to tell you exactly how you're right or wrong. So we're going to go through it piece by piece, and then we'll end the video with some closing thoughts. So what I've done here is I've taken this price swing on a 4-hour chart, and I've marked out the high or the low here to the high, and I've marked this out in premium or discount. You can see on a longer term, this is all the price action that we're worried about, is the internal range of this price swing and the external on both sides. So what I've done is I've marked out it in quarters and then half. So premium is up here, discount is down here. And what I've marked out here is this is an original consolidation right here. And I've marked out the order block of the original consolidation here. And I've marked out the range low. Then what I noted here is a unfilled area of a buy side imbalance, sell side inefficiency below this relative equal low. So this part is unfilled. This candle right here came down and filled a portion of it and then continued higher. So looking through all of this, it looks like we've filled this fair value gap with this move. we filled this fair value gap with this move, and then we moved higher. We get a high here, it's swept, and then on a long-term basis, you have a high, a higher high, and then a lower high. So you get this pattern essentially from here, high, low, high. This high is not as high as that. That is a failed swing. So I look at that and I say, okay, what ideas would it give me that this is a failed swing? Well, it came up into an order block and quickly rejected it. So now what I'm looking for is I'm looking for sell side opportunities. And so what I do is I mark out my lows here, and I go relative equal lows because you have a low here, a low here, a low here, a low here, and a low here. So I have relative equal lows all clustered right here. They're all resting around the same area. I chose this one because it's the lowest low out of all of these. So what we see is we see price has filled in this fair value gap over here. It's filled in this fair value gap over here. It's filled this fair value gap in over here. And we have reached into this order block and then rejected. So now this is our price range. And you can divide this into premium or discount and see what we've done. And what we've done is we have a price swing here. We took out internal liquidity of this price swing. Then we've come down, we created a new range from this high to this low, and we've took out internal range of that liquidity. So my next expectation is, since we've taken out internal liquidity and then also internal liquidity, is to see a move of external liquidity. The easiest liquidity available is here or here on a higher time frame basis. So now we're trading in this range. And what we're going to do is we're going to break this down and we're going to go down into a lower time frame. We're going to go down into a 1 minute or a 1 hour chart. And we're going to see what information we can glean from this. So what we have is a low here. It gets broken here. But now we have these relative equal lows. I have this marked out as a 15-minute relative equal low just because it got me a little bit better idea. I'll show you when we get down to the 15-minute chart. But we have relative equal lows resting below the marketplace. We also have a fair value gap resting above the marketplace. This is a 15-minute time frame. But on an hourly chart, we've just filled in this fair value gap, and we have a 1 hour sell side imbalance, buy side inefficiency unfilled, resting above the marketplace up here. And we have the same pattern of a failed swing created on a 1 hour chart. You have a high here, you have a high here, and then you have a lower high here. So we have this pattern with displacement, meaning a large move lower, fills in a fair value gap on a 1 hour chart here, and then quickly rejects that as well. So a move into this 15-minute fair value gap could be a potential sell. Anything up here would be a stop run. It would be a liquidity run. And then up here you have free orders, essentially. You have a lot of sell side imbalances up here, buy side inefficiencies, meaning there's a lot of gaps. When this candle was painted, essentially, if you go down to a lower time frame, you're going to see large gaps in price action. Here, 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 here. So price could potentially reach up into here in a premium and then reject and move lower. And then long term, you can still see that we have premium discount. We're still in a premium market here. And we have sell side resting below here in a discount. And then we have a discounted PD array nested right below these relative equal lows. And then you have the order block resting below that and the range low. So if you remember when I was talking about the dollar index, we'll go back to it right now. We talked about the idea that if you have relative equal highs and a fair value gap above it, what's most likely a likely probability that it's going to reach into that area up here and then fill this fair value gap is pretty high. If you incorporate ICT concepts and you start thinking about the market, how we've gone over the COT data and the open interest and the relative strength, all of those things kind of lead to this overall market analysis where you mark up your charts. We've come up into an area of premium of this price range. Now we're looking for a discount. If we go back to here, we've come up into a premium. We have relative equal lows here. And then on the opposite side, what do we have resting below relative equal lows? A fair value gap. So if you were looking for shorts, what you could reasonably expect is price to move below these relative equal lows into this fair value gap. Once price does that, if it does it, I should say, if price does that, I would be looking for either a continuation lower or I would be looking for a reversal. And if we go down to a 15-minute time frame, you'll see these other PD arrays that I have filled out. 15-minute fair value gap, we would have liquidity resting above here and the 1 hour SIBI up here, and then a 15-minute fair value gap resting right here. So what we've done is we've created relative equal lows. Now on a 15-minute time frame, this is our range. Range high, range low. We're in a discount of that range. So what we could potentially wait for is a break into premium, see if we get a failed swing, essentially a market maker sell model that would support the overall higher time frame model of a failed swing, and then price should continually support itself lower. That essentially is how I take the ideas that ICT uses in his month 12 top-down analysis and I arrive at a weekly bias. Now my weekly bias might be different than your weekly bias, and that's okay. We all see the market differently, and there's nothing wrong with that. This is just me going over how I do it, and if you want to use ICT concepts, that's really all that I do. I incorporate those into how he has outlined it, and it helps me arrive at a idea of what the weekly candle is going to do. Now, of course, you're going to want to incorporate things like the economic calendar. Just quickly, this is the economic calendar for this week. We're going to have a banking holiday. Tuesday, we have some news. Wednesday, we have higher impact news. And Thursday, we're going to have higher impact news. So for me, it's most likely that we're going to see Wednesday create the higher low of the week, and then a retracement or a reversal or a continuation on Thursday through Friday. Since Monday is a banking holiday, we don't count that. We look at Tuesday through Friday, and this is essentially your weekly profile. So if Monday is going to be a consolidation, Tuesday should have some movement. We should see some movement on Tuesday, especially after a banking holiday. And then Wednesday with this FOMC meeting minutes, this is going to create a lot of stir. Usually you see a move. This is a seek and destroy profile that we would see on Wednesday at 2 o'clock, which is towards the end of the day. And then Thursday, we're going to see unemployment claims, PMI, and home sales, along with a couple of FOMC members and crude oil and natural gas storages and inventory. So you're going to have a lot of news on Thursday that would create economic news drivers to move the market. News drivers or economic calendar events are high impact drivers of the market. In fact, you could say that they're the highest impact drivers, especially with FOMC or CPI or non-farm payroll. Those affect the market drastically, and we're going to see FOMC meeting minutes on Wednesday. So as far as the weekly profile along the ICT lines is, if you see any type of move higher, you're looking for either ejection or a acceptance of that PD array, and once it does that, you can look for a trade. What I'm looking at on a higher time frame is these relative equal lows, targeting the relative equal lows and the BISI resting below those relative equal lows. Price structure has shifted from a buy program down to a sell program here with a break of structure, come up into a 4-hour order block, reject the order block lower. Everything is starting to align lower for a move lower. I don't believe it's a long-term move. That's just my idea, but essentially that's how I do my intermarket analysis, and I hope you found it insightful. And if you like to use these concepts, they're not my concepts, they're ICT's concepts. So whatever you glean from me is from ICT. It's not any of my concepts. I don't claim authorship to any of it. So I appreciate you taking your time to watch this video, and I hope that you found it insightful. If you like the video, give it a like and leave a comment in the comment description if you want to see any more videos on anything else during the week. And I appreciate it. Thanks, guys. Have a good one.